Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now it's the Memorial Day holiday in the US today and markets are closed for the long 3-day weekend. Many of you might already know that Memorial Day is a US holiday to honor those who died fighting for their country. However, it is also significant for energy markets as well, as it's popularly considered to mark the start of summer and the summer driving season. Now, this is usually characterized by stronger energy demand as Americans drive to summer holiday destinations. A tradition that many reports seem to show is like to remain largely undeterred despite high petrol pump prices. Now, while this may mean markets are quieter than usual, they are still open and we have a particularly data-intensive week ahead. Staying with the US for a moment, the first week of a new month marks the release of both ISM manufacturing sentiment in the US as well as employment data towards the end of the week. Now, the ISM is significant as it will help gauge just how much growth is slowing and how much of the focus is shifting from goods to services. Meanwhile, jobs data may end up creating a situation where bad news is good news, in the sense that markets are likely to be reassured the Fed will not further accelerate rate hikes if job creation and wage growth are not much stronger than what's already expected. A very strong number, though, could raise renewed worries of faster Fed tightening. Finally, midweek, the Fed also releases its beige book summary of economic data, which should also help offer another lens on just how much we should worry or not about slowing growth in the US economy. Now, there's a lot there about gauging economic growth, and that's important because it could be the key to whether the rebound in risky assets extends. Now, US equities staged a strong rebound of over 6% last week after what was 7 consecutive weeks of losses for the S&P 500. Now, the most popular question we've been asked is whether this is just a bear market rally or whether it's the start of a more sustained equity uptrend. The answer, as we've said before, lies in whether the US economy is headed for an economic recession or not. Several studies I came across this weekend noted that usually S&P 500 returns in the 3 to 12 months after a 6% weekly gain do tend to be quite strong. The only exception, of course, were years when the economy subsequently headed into a recession. This is, of course, consistent with another chart we published several times ourselves that shows market returns after the approximately 20% pullback the index has seen so far tend to be strong except when the economy ends up in a recession. Now, predicting recessions is unfortunately easier said than done, but that's something we'll be quite focused on the coming weeks as we prepare for a mid-year outlook. Between now and then, though, history argues the outlook is positive, and for this week, we would really keep our focus on whether the S&P 500 is able to break above technical resistance around 4,200. Now, we do have several data points due across Asia as well. China reports its own official and private sector PMI manufacturing sentiment data, which will be key in getting a hold of whether the by now well-known growth challenges are getting better or worse. Most other Asian markets are also due to release their own PMI data points, while India also releases its trade data, which is key for the Indian rupee. Finally, over in Europe, the release of May inflation data is likely to renew ECB rate hike expectations if it indeed does touch a new post-1999 high, as consensus expects, though the silver lining is that this is likely to further support the ongoing rotation towards the euro and away from the US dollar. So potentially, overall, a good week ahead for US equities, but watch 4,200 on the S&P 500, and elsewhere we'll be focusing on the euro and Asian currencies this week, all of which, of course, we'll follow up on closely through this podcast. We'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.